A few years ago, I went to the BC Small Business website, a service offered by my provincial government. Or, as some might say, a vanity project designed to let you know what your government does for you. They offered advice geared to people starting up a new business on the advantages and disadvantages of common business structures for someone starting a new business.
The advantages and disadvantages were taken straight out of an introductory business law course. They weren't really wrong, it's just that they lacked context. And the Small Business BC website wasn't the only online content available. A search on May 17, 2023 found 242,000 hits over the last year. It seems that many advertisers want to connect with people starting a business. At the hatchery, we also serve the small business sector. So we put together this set of 3 videos. Each one is devoted to one of the 3 most commonly used types of business entity. First, let's go through the advantages. 1. Ease of formation. 2. Low startup costs. 3. Additional sources of capital, in other words, your partners. 4. Possible tax advantages. 5. Limited regulation. 6. Broader management base, in other words, your partners will provide additional skills.
Certainly, a partnership is harder to form than a proprietorship. You have to find an appropriate partner, and then you need to reach a meeting of minds as to what you want to accomplish and how you intend to do that. In other words, you need to create a partnership agreement. This is certainly as difficult as forming a corporation. The partnership form of entity has a long history and predates the origin of the corporate form by many hundreds of years. Perhaps because the notion of a partnership is familiar to most of us, most web-based advisors don't adequately describe the complexity of partnership entities.
The startup costs for a partnership are about on a par with those of a corporation. Like any business, context is critical. Startup costs are mostly a function of the nature of the business and not the type of entity.
While each partner might bring his own capital into the partnership, the same could be said for a corporation. In a new business with 2 or more founders, your choice is generally between a partnership and a corporation. From our perspective, the corporate form is usually a better choice. The usual reason a partnership entity is advantageous for a new business is the ability for partners to use startup losses, often carrying them back to higher income years in the past. This works because a partnership is not a person for the purposes of the Income Tax Act. Income taxes are payable by persons resident in Canada and certain non-resident persons. Perhaps surprisingly, corporations are considered persons. Since a partnership interest is owned by a person, in other words, by an actual person or by a corporate person, the owner of the partnership interest may have taxable income in an earlier year. A new corporation, by definition, has no income in a preceding year. For that reason, corporations with losses in the startup year can only claim them in future years. Is that clear? If not, you should check with your accountant.
What kind of regulation do they mean? Regulation is often a function of the business type, not the type of entity. If by limited regulation they meant income tax regulation. Tax compliance is often cheaper, but you will likely be missing out on some tax planning opportunities. Also, certain tax incentives for research and development, the gaming industry, or venture capital incentives to investors won't be readily available. 2 or more founders of a business will each bring their own skills and abilities to a new business. However, this can be said whether they are founding a corporation or a partnership.
Now let's go through the disadvantages of a partnership structure as laid out by Small Business British Columbia. 1. Unlimited liability. 2. Divided authority. 3. Difficulty raising capital. 4. Possible conflict. 5. Mutual agency. 6. Possible dissolution on death or retirement of a partner. 7. No name protection. While a great deal is made of the protection offered by incorporation to shareholders, in practice this doesn't really have all that much value. Most businesses, including limited companies, use insurance to protect themselves from liability. In that way, they aren't much different than sole proprietorships or partnerships. When incorporated companies borrow money, lenders almost invariably require personal guarantees from shareholders. In both a proprietorship and a partnership, you will be held personally liable for failure to meet contractual obligations of the business, or for causing damage to others accidentally in the course of your business.
The flip side of having a broader management base is that partners must consult one another. Realistically, you can't have it both ways.
Difficulty raising capital? Who wrote this? Raising equity in a small business, no matter what structure is used, is very hard. Regardless of what structure was used, if the business is successful, the structure can be modified to suit investors. Partners can be held liable for the actions or decisions of their partners, which is referred to as mutual agency. In reality, though, officers of a corporation can also bind a company. So if you like to pump up your staff in a corporation by giving them fluffy titles, you should probably be careful. If your assistant orders something on your behalf and then signs for it, you'll probably own it anyway, even if you didn't want it.
The theory is that a corporate structure is advantageous in that it is independent of the owners. If a shareholder dies, the corporation continues to exist and his or her shares are owned by their estate. If a partner dies or retires, and if the partnership agreement doesn't specify alternate procedures on the withdrawal of a partner, in most jurisdictions, the default partnership agreement would dictate that the partnership is dissolved. Of course, the answer is to have a properly drafted partnership agreement at the outset. The answer here is somewhat nuanced. My understanding is that Janet Smith, management consultant, can't be stopped from using her own name. If you own a website, you will still own the web address, even if someone else has a similar name. You may even have trademark protection of some sort, if you have been using your business name for some time. If the name of your business has value, you should probably get advice from a specialist in intellectual property. You might even consider incorporating a company to own the name at the outset. Once again, context is critical.